Canada's fourth biggest bank has taken a mammoth hit in the natural gas market. Bank of Montreal says losses from out-of-the-money options will cost the company up to $450 million. The losses will eat into the company's Q2 profit to the tune of 45 to 55 cents a share.
These losses are particularly disappointing and were the result of decisions that didn't adequately recognize the vulnerability of the portfolio to changes in market volatility.
Essentially, the bank bet billions that natural gas prices would go up in the latter half of 2005. But post-Hurricane Katrina, the opposite happened. And instead of getting out of its position, BMO stayed in the market and its losses skyrocketed.
The thing that really surprises people is that their risk monitoring system wouldn't have picked up on the volatility that was increasing in natural gas and would have caused them to close out those losses a lot sooner than this.
Some shareholders are stunned the bank was even invested in a notoriously risky and fickle natural gas market to begin with.
It did not go over very well because we do own Bank of Montreal, and I'm going, what are they doing making such big bets?
I'm sure they thought they were ahead, and I'm sure they thought, according to some financial model, that the risk was low. But, you know, when you deal with derivatives, when you work with, illiquid markets, you can have bad surprises.
Bank of Montreal says the traders that made these natural gas bets are still with the company. Meanwhile, investors are wondering if Bank of Montreal can make such a horrible call on the markets. Why not the other banks?
All of the banks take bets like this, and it's only when one of them blows up like this that you hear about it.
CIBC, rumoured to be the most leveraged Canadian bank to commodity trading, said today it has experienced no material losses in trading. The other big Canadian banks, however, declined to comment. Niall, McGee, BNN, Toronto.